I was talking to a veteran textile exporter recently, a man who spent the last 20 years watching his shipping containers sit at the docks, weighed down by the kind of bureaucratic red tape that kills a business before the cargo even leaves the harbor. For 2 decades, he's lived through the same cycle. A high-level summit is announced, rumors of a breakthrough swirl, and nothing. The talks would stall over the price of French wine or the specifications of Indian car parts, and he'd go back to navigating a world that seemed to be getting smaller, more protective, and a lot more expensive. Instead, he was staring at his tablet with a look of quiet, stunned intensity. He pointed to the news coming out of the 16th India-EU summit in New Delhi. They're calling it the mother of all trade deals. We're not talking about a minor adjustment to a few customs forms. We're looking at a total structural overhaul that slashes or eliminates tariffs on over 90% of goods. Suddenly, for a businessman like him, a market of 450 million European consumers isn't a fortress anymore. It's an open door. What's truly striking, though, isn't just the economic scale, the projected doubling of exports, or the millions of potential jobs. It's the sudden, dramatic shift in the geopolitical weather. After 20 years of bickering, the two sides didn't just find a middle ground, they moved the entire map. They are anchoring this deal to something called the Abrahamic Route, a high-speed corridor of rails and pipelines cutting through the Middle East that would have been a diplomatic impossibility just a few years ago. Now, why, after 2 decades of deadlock, did the impossible deal suddenly become a historic milestone? It's a calculated high-stakes pivot away from the old global gatekeepers and a direct challenge to the maps already drawn by others. We are witnessing the birth of a new economic axis, and the ripple effects are going to be felt far beyond the shipping docks of Surat or the boardrooms of Brussels.
That is a perfect encapsulation of what's happening, that exporter's reaction. It's not just about one deal. He's reacting to what feels like a fundamental shift in the ground beneath his feet.
We're looking at this huge convergence of 2 massive frameworks. First, there's the India, Middle East, Europe Economic Corridor, or IMS.
Right, the physical infrastructure.
And then layered on top of it is this newly finalized India-EU Free Trade Agreement, the FTA.
And that convergence is the key. You can't really understand one without the other. They are completely intertwined.
We're looking at what some people are calling a multimodal revolution. It's not just about ships anymore. We're talking rail, road, digital cables, even hydrogen pipelines. It's a total reimagining of connectivity.
So the mission for us today, I think, is to figure out how these 2 agreements really function together. It's been described as hardware and software, and I think that's a pretty good analogy to start with.
Hardware and software. So the IMSE infrastructure is the hardware. The rails, the ports, the steel.
And the FTA is the software, the regulations, the tariff rules, the code that makes everything run smoothly on that hardware.
Okay, so let's start with the hardware then, part 1. The India, Middle East, Europe Economic Corridor, IMS. When you look at the map of this thing, it seems, well, incredibly complicated.
It does. It's not a simple straight line. It's really a network of networks.
So help us visualize this. How does it work? Practically.
Okay, so you have to think of it in 2 parts. There are 2 main corridors. The first is the East Corridor.
Right.
This part connects India to the Arabian Gulf. So you're talking about a container leaving, say, the port of Mumbai on the west coast of India.
Okay, a standard sea route.
Exactly. By sea, it travels to the UAE, to a major hub port like Jebel Ali. That part is fairly conventional. Is what happens next that's completely different.
This is where the trains come in.
This is where the trains come in. This is the Northern Corridor. So instead of the ship continuing its journey around the Arabian Peninsula and up through the Red Sea,
the usual Suez Canal route,
that container is offloaded in the UAE and put onto a railway. That railway then travels across the desert, through the UAE, across Saudi Arabia, then north through Jordan.
All the way up to Israel.
All the way up to the port of Haifa in Israel. And that's the end of the land bridge.
And from Haifa, it's back on a ship.
Back on a ship for the final leg across the Mediterranean. It can then enter Europe through a number of ports. Piraeus in Greece is a major one, or maybe Trieste in Italy, Marseille in France.
Okay, I have to stop you there because my first thought, and probably a lot of our listeners' thoughts, is that this sounds like a logistical nightmare. You're loading a box on a ship, offloading it, loading it on a train, crossing 3 or 4 borders, offloading it again, loading it onto another ship.
Yeah.
I mean, every time you touch a container, it costs money. It adds time. It risks damage.
It's called transshipment. Yes.
So why would anyone do this? Why not just stick with the simple direct sea route through Suez that's been used for over a century?
The whole value proposition hinges on two words: speed and resilience.
Okay, let's take speed first. How much faster can it really be?
The initial projections are pretty startling. They suggest this multimodal route could reduce the total transit time between India and Europe by up to 40%.
40%? We're talking shaving, what, 10 days, 2 weeks off a journey?
Something in that neighborhood, yes. And that's where the economics start to shift. For low-value bulk goods like, say, coal or grain, you're right, the extra handling costs might not be worth it.
But for high-value goods?
For high-value goods, time is literally money. Think about inventory holding costs.
Right, the cost of having your capital tied up in a product that's just sitting in a box on the ocean.
Exactly. If you're a German car manufacturer waiting for a shipment of critical electronic sensors from India, those sensors represent millions of euros of capital. Every day there at sea is a day that capital is unproductive. Shaving 10 days off that journey frees up a massive amount of working capital.
So the math starts to make sense for certain industries: electronics, pharmaceuticals, high-end automotive parts.
The second part of the equation is resilience, or what we could call strategic redundancy.
A backup plan.
A very necessary backup plan. Right now, something like 12 to 15% of all global trade flows through two very narrow choke points: the Bab el-Mandeb Strait and the Suez Canal.
And we've seen how vulnerable that is. The Ever Given getting stuck was a perfect example. It caused a global traffic jam.
It was a wake-up call. That one ship caused a sort of cardiac arrest for the global supply chain. But it's not just accidents. You also have geopolitical instability, piracy.
Like the disruptions we've seen in the Red Sea recently.
Exactly. The IMEC corridor is designed to be a bypass. It's a way to de-risk the supply chain by creating a viable alternative route that doesn't depend on those choke points.
This idea isn't just theoretical, though. I mean, companies are actually making these calculations right now. I came across a fascinating story that really brings this home. It puts you right inside the boardroom of a European company trying to solve this exact problem. I recently read a report about a logistics director in a specialized automotive parts firm based in Stuttgart. For years, his spreadsheets were a nightmare of Suez Canal congestion, spiking maritime insurance premiums. Try to imagine the tension in that boardroom. Every time a geopolitical tremor hit the Red Sea, their just-in-time supply chain for critical sensors from India would effectively paralyze. I heard that when the India-Middle East-Europe economic corridor was first integrated into their strategy, the internal debate was fierce. They had to calculate the marginal cost reduction of rail-to-sea transit against the geopolitical risk premium of a route traversing multiple volatile jurisdictions. Eventually, the data won. The corridor wasn't just a faster route, it was a resilience buffer that allowed them to bypass traditional bottlenecks. Reading this, I can't help but feel the heavy weight of strategic autonomy. To some, it sounds like dry trade jargon, but for a manufacturer in Germany, it represents the desperate search for a stable pulse in a chaotic global market. While some might view this pivot as an expensive geopolitical hedge, from my perspective, it's a necessary, albeit cold, calculation to ensure that the European industrial heart continues to beat despite the fragility of traditional trade lanes.
That phrase from the story, geopolitical risk premium, that is absolutely central to understanding this entire project.
Let's break that down for a second, because it's not a cost you'd typically see on a shipping invoice next to fuel and port fees. What is it exactly?
It's the price of uncertainty. For that company in Stuttgart, running a just-in-time assembly line means parts have to arrive within a very specific window. If that shipment of sensors is delayed by a week because of trouble in the Red Sea, it's not just an inconvenience.
The whole production line shuts down.
The whole line shuts down. And that can cost them millions of euros an hour. The geopolitical risk premium is what they're willing to pay to avoid that scenario. They're not just buying transport. They're buying certainty. They're buying insurance against chaos.
So in that calculation, the slightly higher cost of rail freight or the complexity of transshipment suddenly looks like a bargain compared to the cost of a factory going dark.
It becomes a very cold, rational calculation. The resilience buffer isn't a luxury. It's a core business necessity in the modern world.
But there's still a debate to be had on the pure economics of rail versus sea. You know, a modern container ship can carry 20,000 boxes, a train, a few hundred at most. The economies of scale for shipping seem unbeatable.
On a per kilometer, per ton basis, you're right. Deep sea shipping is incredibly efficient for bulk. But again, IMEC isn't trying to compete on shipping bulk commodities. It's targeting the higher value segment where that trade-off we mentioned, higher freight cost versus lower inventory holding cost, makes sense.
Okay. But what about the environmental angle? We hear so much about green shipping and green corridors. A ship, for all its faults, is pretty efficient per ton of cargo moved. A diesel train crossing thousands of kilometers of desert, is that really a greener option, or is this just marketing?
That is a very, very sharp question. Depends. The math is nuanced. The corridor substitutes about 300 to 700 kilometers of sea travel with about 2,600 kilometers of rail, so shorter distance, which is good, but the energy source is everything. If those trains are running on diesel locomotives,
Then the carbon footprint per container could actually be worse than a modern ship.
good. The green promise of this corridor is entirely conditional. For it to be truly a green alternative, that entire rail network has to be electrified.
And the electricity has to come from clean sources.
Exactly. You can't just plug it into a grid powered by oil or coal and call it green. That's just outsourcing the pollution. The entire vision for IMEC's environmental credentials relies on a parallel, massive build-out of renewable energy, particularly solar, in the Middle East, to power that rail network.
So without that massive investment in green energy, the green corridor label is, let's say, more aspirational than factual at this point.
It's a critical dependency. The hardware of the railway needs the hardware of the solar farms to deliver on that promise.
Okay, so that's the hardware. It offers speed and resilience, but it comes with a lot of big ifs.
Let's pivot now to the software side of this. The free trade agreement. The mother of all trade deals. This is where things get just as transformative, if not more so. The India-EU FTA is. It's a real paradigm shift, especially for India.
Why for India in particular?
Well, historically, you have to remember that post-independence India was a very protectionist economy. The whole model was built around high tariff walls to protect domestic industries from foreign competition.
The license raj and all that.
Precisely. And this deal just blows that model up. The headline stat is the elimination of duties on 96.6% of all goods coming from the EU into India. That's a complete reversal of decades of policy.
96.6%, that's almost everything. But let's get into the specifics. What are the big ticket items here? I'm guessing German automakers are pretty happy about this deal.
They are ecstatic. The automotive sector is probably the single biggest winner on the European side.
What were the old tariffs like?
Well, if you wanted to export a fully assembled car from, say, Germany to India, you were looking at tariffs as high as 110%.
So you're more than doubling the price of the car before it even hits the showroom.
It effectively priced them out of anything but the super luxury market. The FTA slashes that tariff down to just 10%.
And what about car parts? Because that's a big part of the supply chain, too.
That's maybe even more significant. For components, engines, gearboxes, electronics, the tariffs will phase out completely, down to 0% over a 5 to 10 year period.
Okay, so you can see why Europe is excited. But what's in it for India? Why would they agree to open their market up like this? Doesn't it risk hurting their own domestic car companies?
It certainly forces them to compete, which can be painful. But the logic from the Indian side is about integration, not isolation. By getting cheaper, high-quality European components, Indian manufacturers can improve their own cars. It could actually make their own exports more competitive on the global stage. It's a bet that joining the global supply chain is better than trying to build one behind a wall.
A pretty big bet. But you mentioned 96.6%. What's in the other 3.4% that's being protected? That's always the most sensitive part of any trade deal.
And it's always agriculture.
Always.
The third rail is India has drawn some very clear red lines. It has completely excluded its most sensitive sectors from these tariff cuts. We're talking about beef, dairy products, rice, and sugar.
To protect the livelihoods of millions of farmers.
Yes, the agricultural sector in India is just massive, both in terms of employment and political sensitivity. Flooding the market with duty-free European dairy, for example, could have been devastating for countless rural communities. So the software of this deal had to be written with these exceptions to be politically survivable in India.
Okay, so a massive opening for manufactured goods, but protections for sensitive farming sectors. But modern economies are driven by services as much as goods, and services ultimately mean people.
Yes, and this is where the FTA gets really innovative and for some quite controversial. We're talking about labor mobility.
The movement of skilled workers. I found a story that really personalizes this. It's not about the abstract numbers, it's about what this means for an individual professional and for the European companies that need them. It's a fascinating look at this idea of demographic arbitrage. I saw an interview online with a young systems architect named Vikram who recently moved from the tech hubs of Bangalore to an aging industrial cluster in northern Italy. Under the institutional mechanisms of the new India-EU Free Trade Agreement, his transition wasn't a bureaucratic nightmare, but a streamlined demographic arbitrage. I heard that his new colleagues in Italy were initially worried about labor mobility, fearing that the influx of skilled workers might dilute local standards or suppress wages. However, the story changed when they realized that Vikram wasn't there to replace them, but to fill a void that had been causing a steady decline in their factory's productivity for a decade. The FTA's focus on harmonizing labor standards meant he arrived with recognized certifications and a shared professional language. It's a fascinating narrative of human capital bridging a productivity gap. Looking at this through a modern lens, I understand why this triggers anxiety regarding national identity and local job security concerns that are often voiced on the political right. However, when you look at the demographic cliff Europe is facing, these mobility bridges seem less like a choice and more like a lifeline. It's about finding a middle ground where the dignity of the local worker is protected while acknowledging that without this skilled mobility, the entire sector might simply vanish.
That term, demographic arbitrage, it sounds a bit cold and clinical, but it really gets to the heart of what's driving the services part of this agreement.
It's a simple, stark reality, isn't it? Europe's workforce is aging and shrinking. India's is young and growing.
That's the fundamental imbalance. You look at the demographic charts for much of Europe, and they're facing a steep cliff. The working age population is declining, which puts a natural cap on economic growth. You can't increase productivity if you don't have enough skilled people to do the work.
And India has the opposite situation, a youth bulge, as they call it.
Exactly. India is producing millions of highly skilled graduates in engineering, IT, and other STEM fields every year. There's a surplus of talent that needs high-quality jobs. This deal is designed to create a bridge between that supply of talent and Europe's demand for it.
But we've seen attempts at this before, and it often gets bogged down in a swamp of bureaucracy. Visa applications, arguments over whether an Indian engineering degree is equivalent to a German one. How does this FTA solve that?
It creates specific, legally defined pathways to make it easier. For example, it establishes formal categories like contractual service suppliers and independent professionals.
Okay, what's the difference?
A contractual service supplier would be, say, an employee of a big Indian IT firm like Infosys or TCS. They're sent to a client in Europe to work on a specific project for a limited time, maybe up to a year.
So it's temporary and project-based?
Right. And an intracorporate transferee could be a manager from an Indian company sent to run their new branch in Milan for, say, up to 3 years. The crucial point is that these are designed as temporary work arrangements tied to specific economic needs. It's explicitly about mobility, not permanent migration.
That distinction is probably very important politically. But what about the other big hurdle, the story about Vikram mentioned, getting his qualifications recognized?
That's probably the most ambitious part of the services agreement. It's called mutual recognition of qualifications.
So an accountant certified in Mumbai is recognized as qualified to work in Berlin.
The FTA doesn't automatically grant it, but it creates a formal framework for the professional bodies in both India and the EU, the engineering institutes, the architectural boards, the accounting associations, to sit down and formally assess and align their standards.
So they can say, yes, your certification process is as rigorous as ours, so we will recognize it.
Exactly. And if they can achieve that, it creates a truly fluid international market for talent. It's what some call brain circulation instead of the old fear of brain drain.
So we have this incredibly ambitious hardware project, the IMEC corridor, and we have this incredibly ambitious software, the FTA, that lets goods and people move along it. But none of this happens for free. In fact, it's mind-bogglingly expensive. We have to talk about the financing.
The money, yes. This is where the entire grand vision could easily fall apart.
The estimates I've seen for the full build-out of IMEC, all the rail, ports, pipelines, cables, are somewhere in the neighborhood of $500 billion.
$500 billion, and that might be a conservative estimate.
Who on earth is going to pay for that? Private investors are usually spooked by long-term infrastructure projects, especially in a region as volatile as the Middle East.
It's what the analysts call the financing gap. Infrastructure is a tough sell. It requires enormous upfront capital expenditure, and the returns, while potentially stable, are spread out over 20, 30, even 40 years.
That's not a timeline that gets your typical private equity fund excited.
Well, they want to return in 5 to 7 years. So I was reading about a very specific, immediate problem. There's a $5 billion shortfall right now just to build the missing links in the railway.
The sections in Jordan and Saudi Arabia that don't exist yet.
Right. It's about 300 kilometers of track.
Mhm.
And $5 billion sounds like a lot, but in the grand scheme of the project, it's almost pocket change. But without that $5 billion, the entire multi-hundred billion dollar corridor is useless. A railway that's 95% complete is 100% non-operational.
So how do they bridge that gap? How do you get investors to take on that risk?
The solution they're working on is a kind of hybrid financing model. It's not purely private, and it's not purely public. It relies on bringing in the big sovereign wealth funds.
We're talking about the massive state-owned investment funds, right? Saudi Arabia's PIF, the UAE's ADS.
Yes, and their European counterparts, like the European Investment Bank. But even they need to see a viable financial structure. It's not just about having deep pockets. It's about how you engineer the investment.
On that note, I saw a fascinating analysis from a strategist who deals with exactly this kind of problem. He breaks down how you actually build a financial model to fund something this massive and risky. It's less about construction and more about financial engineering. I remember watching a deep dive analysis by a French private equity strategist who was tasked with evaluating the sovereign private capital models required to fund the IMF infrastructure. Imagine the sheer scale of the vision. A digital and physical spine of high-speed cables and hydrogen pipelines stretching across the Eurasian landmass. He described a complex web of investment vehicles designed to mitigate the risks for institutional investors who are typically terrified of long-term projects and shifting political landscapes. I heard that they are now looking at risk mitigation strategies that involve state-backed guarantees to attract the trillions of euros sitting in pension funds. This isn't just about building tracks and ports, it's about creating a strategic asset class. Reading between the lines of these financial models, I see a profound shift in how the West is trying to compete with established global infrastructure initiatives. As a news creator, I find the scale of this financial engineering both impressive and slightly daunting. While critics might see this as a globalist project that prioritizes capital over community, I see it as a pragmatic attempt to build a multipolar world. It's a high-stakes bet that by weaving the financial interests of European pensioners with the infrastructure of the Middle East and India, we can create a corridor of stability that transcends mere commerce.
The key phrase there is creating a strategic asset class. That's the real innovation.
Terms. He mentioned state-backed guarantees. Is that just a fancy way of saying the taxpayer bails out the project if it goes wrong?
Yes. Think about a giant pension fund in Europe. They manage the retirement savings of millions of people. They're legally required to be extremely risk-averse. They can't just gamble that money on a railway in Jordan that might get caught up in regional politics.
So they need a safety net.
They need a safety net. So the model they're building involves the sovereign wealth funds or state investment banks providing what's called a first loss guarantee. They effectively say to the pension funds, you invest alongside us, and if the project runs into trouble, we will absorb the first, say, 20% of any losses.
So that de-risks the investment for the private capital. It makes a volatile region look as safe as, say, a German government bond.
Yeah. It's using public capital to unlock trillions in private capital that would otherwise never touch a project like this. It's about aligning the financial interests of European pensioners with the strategic interests of building this corridor.
The strategist in that story also mentioned something beyond just rails and ports. Hydrogen pipelines. We touched on this with the idea of green trains, but it seems like the energy component of IMEC is a whole project in itself.
It's arguably the long-term grand prize of the entire corridor. The trade in goods is important, but the trade in energy could be truly transformative for Europe.
Why is this corridor the perfect place to produce and transport it?
It boils down to the simple economics of sunshine. To create green hydrogen, you use a process called electrolysis, which requires immense amounts of cheap, clean electricity to split water into hydrogen and oxygen.
And the Middle East has an abundance of sun and empty land.
Some of the best solar potential in the world. The cost of generating solar power in places like Saudi Arabia and the UAE is plummeting. They're hitting record lows, something like 1.3 cents per kilowatt hour. That makes it one of the cheapest places on Earth to produce green hydrogen.
But why a pipeline? Couldn't they just liquefy it and put it on a ship like they do with natural gas?
Good.
Yeah.
And they will for some markets. But shipping it usually means converting it to a carrier, like ammonia first, which costs energy, and then converting it back at the destination, which costs more energy. A pipeline is a far more efficient continuous flow. It's like a giant extension cord connecting the green battery of the Middle East directly to the industrial centers of Europe.
Which gives Europe a way to diversify away from its reliance on other energy sources.
A huge strategic win. It's about achieving that strategic autonomy the Stuttgart logistics director was talking about, but on a massive continental scale.
And running right alongside these pipelines and railways is the digital component.
The digital spine. This is the high-speed fiber optic cables, both undersea and terrestrial, that are being laid along the same route.
Now, does that really make a big difference? I mean, we're all connected to the internet already.
It matters for two reasons: latency and integration. For certain industries, like high-frequency financial trading, shaving even a few milliseconds off the data transmission time between Mumbai and Frankfurt is worth a fortune.
Okay, so a faster connection.
But the bigger picture is about creating a seamless digital and financial ecosystem. The ultimate goal is to directly link financial systems, for example, to connect India's wildly successful UPI payment system with Europe's SEPA network.
So what would that mean for an ordinary person?
It could mean an Indian tourist paying for a coffee in Rome with their phone, instantly, with no currency conversion fees, bypassing the traditional credit card networks entirely. It creates a parallel financial railroad that runs on the same tracks as the physical one.
It all sounds incredibly ambitious, almost utopian. Which brings us to the big overarching question. Now, after 20 years of stalled talks, why is this all happening with such speed and scale right now?
The geopolitical tectonic plates has shifted. I think there are two main drivers. The first is the Abraham Accords.
The series of agreements that normalize diplomatic relations between Israel and several Arab nations, most notably the UAE.
Without that diplomatic breakthrough, the map of IM that we just described is a fantasy. You simply cannot run a train from the UAE through Saudi Arabia and Jordan to a port in Israel if those countries are officially adversaries and their borders are sealed.
So the Abrahamic route isn't just a name, it's a literal description of the new political reality that makes it possible.
Exactly. It's taking that diplomatic architecture and reinforcing it with concrete and steel. The idea is to create so much economic interdependence, shared pipelines, shared railways, shared ports, that conflict becomes prohibitively expensive for everyone involved.
So that's the regional driver. What about the global one? It's impossible to talk about a massive infrastructure project like this without talking about China's Belt and Road Initiative. Is IMS simply an anti-China project?
The architects of the project are very careful to frame it not as anti-China, but as pro-diversity or pro-alternative. The Belt and Road Initiative, or BRI, has been the dominant force in global infrastructure for the past decade. It has built an incredible amount of connectivity. IM is being presented as a different model, an alternative offer. It emphasizes different principles, transparency, sustainable financing, and a greater role for private capital.
So for a country in the Middle East or elsewhere, it's no longer a one-stop shop. They now have competing offers on the table.
And that gives them leverage. It's about creating a multipolar world where there isn't a single monopoly on how global infrastructure is built and financed. It's also backed heavily by the U.S., which sees it as a way to connect its key allies, India, the Gulf states, Europe, Israel, without having to be the primary check writer itself.
Okay, but we have to inject a heavy dose of realism here. The roadblocks are immense. The corridor runs right through one of the most volatile regions on the planet.
That geopolitical risk premium we discussed isn't theoretical. It's a daily reality. The recent conflicts, whether in Gaza or the Red Sea, are a brutal reminder of how quickly the best-laid plans can collide with reality.
So how does that affect the project? Does it kill it before it even gets started?
It certainly makes financing those missing links much harder. Private investors get very nervous when they see conflict flaring up right next to their proposed railway line. The bet, however, is that these projects are so long-term that they will outlast the current cycles of conflict. But it's a huge gamble. Security guarantees will be the biggest hurdle.
And even if you solve the security problem, you have the bureaucratic nightmare of crossing all those borders. You can have the fastest train in the world, but if your container gets stuck in customs for 3 days at every frontier,
the entire speed advantage is gone. This is where the soft infrastructure is almost more important than the steel rails. They have to create unified digital customs systems, maybe using blockchain for trade finance, to allow a container to move seamlessly from one country to the next without being stopped and physically inspected over and over.
That sounds almost harder than building the railway itself.
Aligning the bureaucracies of 4 different countries is a monumental task.
And one last technical point that seems crucial for the FTA to work with this corridor, the rules of origin.
Yes, a detail that can make or break a trade deal. Rules of origin are the criteria used to determine the national source of a product. To get the benefits of the EU-India FTA, the low tariffs, a product has to be genuinely from India.
To prevent a third country from, say, shipping their goods to India, putting a Made in India sticker on them, and then sending them to Europe duty-free to cheat the system.
Exactly. The rules are incredibly complex, distinguishing between goods that are wholly obtained in a country, like a crop grown there, versus goods that have just had some value added, like assembling foreign parts. Proving a product's origin without creating crippling paperwork is one of the biggest challenges for making this whole system flow efficiently.
So synthesizing all of this, what we're looking at is a monumental ambition with a staggering price tag, running through a geopolitical minefield, and dependent on unprecedented levels of cooperation. And yet, it's moving forward.
Because the strategic logic for all the key players is compelling. It represents a fundamental shift in economic thinking, moving away from a world obsessed only with just-in-time efficiency.
Where everything is optimized to the last penny, making it very fragile.
To a world that values just-in-case resilience. A world where you're willing to pay a little more for security, for redundancy, for a backup plan.
And the ripple effects of this are going to be felt everywhere. This will change everything from the price of olive oil you see in a Mumbai supermarket to the availability of skilled software engineers in a factory in Milan.
It creates a new economic axis, a new center of gravity in the world that connects 1.4 billion people in India with 450 million consumers in Europe, with the energy and capital of the Middle East acting as the bridge.
We often think of maps as static things, drawn in ink and fixed by borders. But looking at the sheer scale of the IMS and this trade deal, it becomes clear that money and infrastructure can redraw geography faster than any army. The question isn't just whether this corridor will get built, but who gets to define the rules of the road for the next century. We're watching the Middle Earth of the global economy, the space between East and West, finally asserting its own gravity. And for the first time in a long time, the center of the map is holding the pen.